Seems like every time we get together, there's something in the background. There's something big going on. And I would say this time is the fact that the latest inflation data have been disappointing. You've done 300 basis points of rate hikes since March. The core CPI basically is stalled out. The headline CPI is stalling out just over 8% year over year. Core number continuing to rise. And the employment market, the market's still tight in terms of jobs and the economy not slowing down. So what's gone wrong? All those rate hikes, what have they done?
Well, I do think they will have an impact, and in some ways have had an impact. I would cite the housing market in particular, where it appears that increase in rates has really changed the dynamics there. So that's someplace that I would say there are not long and variable lags. That market anticipated Fed moves that before they were even in train this spring, and so that's a place where we've seen impact right away. But it's a big ship, and it takes a while to steer the ship, and so the housing market is not the whole economy. So
it certainly isn't, and it's certainly not one of the main things driving inflation now. Of course, prices have fallen, but
rents are important, though.
Well, they certainly are.
Yeah.
They certainly are, and in fact, that's one reason why people are so worried about inflation staying high next year, is that those rents are, the way they are calculated, they're going to spread out over several months.
Yeah, but we're aware of the lags in the calculation, and so we'll take that on board and take a look at that. But yeah, you're right. The core measure of PC inflation is still in the high 4s, and the Dallas Fed trim mean 4.75 or so. So pretty high inflation in the U.S., even if you try to trim out some of the more volatile components. So we're going to have to get that turned around, moving in the right direction, and back toward 2%.
So how are you going to do that? What does this mean for the restrictive terminal rate? The September SEP's medium target interest rate, 4.4% this year, 4.6% next year. After the latest data, what are your projections now?
Well, if you look at the September Summary of Economic Projections, the so-called dot plot, it did seem that the committee was coalescing around further rate increases at upcoming meetings, even by the end of the year. So that seems to be the base case right now. Most of that has been priced into markets, so I would anticipate that that's having an impact right now. So that's good news if you're trying to get inflation down. But we'll have to follow through on that in the subsequent meetings this year and get the policy rate up to a level where we can put meaningful downward pressure on inflation. I think that's the main goal immediately ahead of us at the committee.
So, off the cuff right now, what would you say that level looks like it's going to be? Is it going to be higher, for example, than you thought it might be? Is that the risk here? Not that you're going to be okay or you're going to move it lower, but they're actually going to need to have more rates to get to a more restrictive level.
Yeah, I've done this calculation about sort of a minimal level that you would have to get to put downward pressure on inflation. I did it at a conference in Stanford in May, and you can look it up on my webpage. But at that time, the number came out to 3.5%. But since then, the inflation news, unfortunately, has continued to surprise to the upside. So if you do that again now, you're going to get something closer to what's in the dot plot, 4.5, 4.75, something like that. And I think also, we're data dependent and we're watching the data. I think we're predicting, or at least the dot plot is predicting, that inflation will come down. It will be a disinflationary year in 2023. But, there's also risk that we don't, the data doesn't cooperate the way we expect it to, and in that case, we'd have to react.
There's an old axiom in monetary policy that, especially when you have inflation like this, that's very high, that hasn't cooled off, that to get it under control, you have to get the funds rate above the rate of inflation. You're pretty far from there now. Another reason to think that maybe, the tilt of risks here is that you're going to have to do more. Some people are talking about 5% and have been for a while.
If we get driven to that, it will be because of the data. I mean, the markets are expecting inflation to fall. We've been expecting inflation to fall. I've been expecting inflation to fall, and it hasn't so far. But I think in the first half of 2023, that's still the expectation. And so you will get to some point where inflation has come down some, and you might get to this situation where the policy rate's above the inflation rate.
So why do you still expect that? I mean, if I can push a little harder, because you've been expecting it, markets have been expecting it, and so far that expectation has been wrong. Why do you still expect that?
Well, I think we're taking forthright action to try to get inflation under control. I think there are some temporary factors. I think they were probably overemphasized earlier in this process, but some of these factors, like the war in Ukraine and the supply chain disruptions from the pandemic, certainly do look like they should abate, and some of them have been abating, and we'll probably get more of that going forward. So the thinking has been that those types of things are probably not the types of things that you'd want monetary policy to be reacting to because they're too volatile. But the underlying inflation has been relatively high. We cited already the core PC and Dallas Fed trim mean numbers, which are pretty high, and that's the part that you probably have to act more directly on for monetary policy. But there you're talking about the high 4% range.
So is one of the reasons that you are still betting on this inflation coming down and not having to move the rate a lot more restrictive is because you're going to stay aggressive with rate hikes right now. 75 basis points in November, and then another 75 in December. I know you don't like to prejudge meetings. However, if you look at how the factors are stacking up, is that a likely outcome in terms of what you're going to vote for?
Yeah, I mean, the November meeting has been more or less priced into markets at the 75 basis point number. Again, I think you do want to wait till you actually get to the meeting, see what the situation is there. The December meeting is a little farther away. We will have more data at that point. I don't want to prejudge exactly, what I'd support at that meeting. And then in 2023, I think we'll be closer to the point where we can run what I would call an ordinary monetary policy, or a monetary policy where now you're at the right level of the policy rate, you're putting downward pressure on inflation, but you can adjust as the data come in 2023. And so I think up to now we've been, we started off at a very low level. That's why we've moved so fast, so far, so quickly. But at some point we'll get to a level that the committee judges will be sufficient to put meaningful downward pressure on inflation. Then we'll be able to adjust from there. Not that there wouldn't be further adjustments, but they would be dated. They would be more based on the data coming in, as opposed to us trying to get off zero and up to some level that's reasonable.
Well, let's apply data dependency to the December meeting then. That's only a few weeks away. Inflation is still high, and in fact, when you looked at the core numbers, it looked like some key sectors, medical care, shelter costs, looks like they could be becoming more entrenched. So again, against that backdrop, wouldn't a 75 basis point hike and a little more aggressiveness going into that 2023 drop in inflation you hope to create, wouldn't that be the right thing to do?
Yeah, if you look at the SEP, the median dots do call for further moves in 2023. So if you take that as the committee sentiment, there could be a decision to move that into 2022 at the December meeting, so you could do that. But again, why prejudge that meeting? And how much difference would it make from a macro perspective, I think, would be a good question as well, whether you put the 25 basis points there or you put it in the first quarter. Well,
what about expectations? What about markets? What about showing people that you've noticed that inflation is still pretty high and you intend to do something about it?
Oh, yeah, we definitely do, and we definitely have moved very quickly here. But this would be more a tactical issue on the larger strategy.
And speaking of 2023 and hoping that inflation is going to get to the point where you want it, would that be a point where you would say, yes, it's time to pause?
I think there's a possibility of a good dynamic in 2023, so let's cross our fingers that we get it. But I think if inflation does start to decline meaningfully, we can stay where we are at this higher level of the policy rate that meets the committee's criteria. And at that point, we could watch inflation fall and get back to 2%. That would be a very good dynamic, I think.
Calibration. That's another Fed word now that showed up in the minutes of the September 21st meeting. And people assume, because you've already been going pretty fast, the calibration would mean slowing down. Is that a correct interpretation of this calibration of rate hikes going ahead?
Yeah, I mean, you do have to think about what the reasonable level is. I think these 75 basis point moves have been because we started at such a low level, so we're way below any kind of concept of a long-run neutral. So step one is to at least get up to the long-run neutral, then get above that, then get to some meaningfully restrictive level that would be appropriate for the level of inflation in the economy. But it doesn't mean that you go up forever. The committee is going to reach a judgment at some point about, how much is the right amount. And that's what I want to get this idea across of transitioning to sort of what I would call ordinary monetary policy, and you might too, looks more like the 1990s or something like that. So no, you're not at zero rates anymore. You're at some higher level of rates, but from that higher level, you're adjusting to various things that are happening in the economy, including on the inflation front. Does it mean you couldn't go higher? No, you could go higher depending on the inflation developments, or you could stay there and watch inflation fall. Those would both be possibilities. But it wouldn't, you'd be out of this kind of very rapid rise in rates.
Is that something that's important for people, and particularly people in the markets, to realize that pausing or slowing down the pace of hikes does not mean that they end? It doesn't mean that you declare victory on inflation. You just decide that you've tamed it enough that it doesn't need such aggressive moves.
Yeah, I think if you're... What I mean, anyway, by putting meaningful downward pressure on inflation would mean that you're at a level of the policy rate where you're confident that, okay, I think we're doing we have the right policy, we're doing the right thing, and even if inflation blips around a little bit, maybe in the wrong direction in one report or something, you still feel confident that I've got the right policy even for that situation.
So then are you in that camp, though, that thinks that going slower would be better now because there is a risk of financial instability? We have seen these aggressive rate hikes reverberating not just in the U.S. economy, the U.S. mortgage market, but in other economies around the world.
Yeah, I think step one is to get to the right level, then from there to become data dependent. So, I don't know exactly the argument for approaching the right level slowly. I think on the question of financial stability, I've been citing the St. Louis Fed's Financial Stress Index. That index was at a high level in 2008, was again at a high level in the pandemic, but now is at a very low level. So it doesn't look like there's a lot of financial stress. We'll keep our eye on this, but for now, it doesn't appear that there's a lot of what you would call financial stress in the U.S. economy.
If there were, would it be a possibly that the balance sheet runoff could become a tool in the sense you would say, well, maybe we'd slow it down, maybe we'd stop removing liquidity, because that's been one of the things that a couple of weeks ago was quite an issue in the bond market. That it seemed like it's illiquid. We're not able to get what we want here. Would that be again become, if you're not worried about it now, if it does become a worry, is that something that you could do?
Yeah, I mean, we certainly keep an eye on liquidity conditions in the Treasury market and other important markets, but I think when people are talking about financial conditions, they're looking at financial conditions indexes that put a lot of weight on equity pricing. And it's not so clear to me that you just want to have that be your metric, because what if the equity prices were exceptionally high in the past, and now they've come down, or more speculative bets in that particular market have cooled off because of the higher interest rates. It's not clear to me you want to call that tighter financial conditions. If you're concerned about the level of wealth to disposable income, that's actually still quite high for the U.S. economy. So it's not really a wealth effect as you would traditionally think about it. So I think there's some mixing here of the idea of financial stress, which I think is not high according to our index right now, as opposed to financial conditions. And if you have a financial conditions index that's just going to cite the fact that equity markets are down 20-something% this year, well, then you're going to say, well, basically the Fed would be reacting to the equity market. But I don't think we should be doing that because it's too volatile and it's often has excesses in pricing.
Well, this question about how high rates are going to have to go, how restrictive it's going to get to be, is not just about inflation, it's about the economy, because the economy is so resilient. It still seems so strong. We had a story today on Bloomberg which got a lot of attention about the little phrase in the minutes from the September 21st meeting, where the board staff economist revised down significantly their estimate of U.S. potential output, the idea being, the economy is running even hotter than we thought. What does that mean in terms of eyeing policy, and again, how restrictive, where you're going to go next?
Yeah, as you know, I've had a regime-based approach to potential growth, and for now I think we're still in the low productivity growth regime, so we're still in this rather slow overall pace of productivity growth. Demographics are obviously not going so well for the U.S. as they would have earlier in the post-war era. And other factors, I think, continue to suggest that the underlying growth rate for the U.S. economy is probably in the low state. But I haven't revised that. I was always at this lower number anyway, so I haven't revised that based on the most recent data. I would say this also: the productivity numbers for the first half of the year are extraordinarily negative. And the U.S. economy added 3.2 million jobs in the first half of the year. So what were these firms doing? They were adding all these workers and getting less output. I think that's a tough story to tell. I think that'll get revised. I think the GDP number will get revised out for the first half, but probably not until some benchmark revision too far in the future to be useful for monetary policy. But it doesn't ring true that you would have that many jobs added and that many firms making those decisions if they're really getting less output by adding those workers. There's some stories you can tell that maybe productivity is not growing as fast, but to have a big negative number there is kind of questionable.
And I just want to let our radio audience know, in case they don't recognize the voice of Jim Bullard, President of the St. Louis Fed, that I'm here, Kathleen Hays, in St. Louis, at the bank, talking to him at length. And in terms of that GDP upgrade, how big do you expect it to be? Is it another thing that's going to change people's view and say, wow, the economy is even slowing less than we thought? Yeah,
I think the first half of the year, according to the numbers we have today, it was a negative first half. I think probably a zero first half is probably a better guess. We'll see, and these are revisions far in the future, so you won't be able to check whether I got it right or not. And I think third quarter growth looks like it'll be positive. So so far so good. I also think that on the labor market side, we've continued to see a very strong labor market. Unemployment rate at 3.5. Unemployment insurance claims very, very low, and probably lower than 2017, 2018, 2019 for this time of year, if you take out the hurricane. And the labor market conditions index as put together by the Kansas City Fed would say that this is the best labor market that we've had since the late 1990s, and one of the best labor markets we've had in the entire post-war era. So I think on the employment side of the mandate, we're in great shape. Okay. So it's a great time to be fighting inflation, and it's a great time to try to nip inflation in the bud and get it back to 2%, or going in the right direction, back to 2%, while the labor market's strong. So I think we've got a shot at that in 2023. You read my mind.
because the next thing I wanted to ask you about was you seem to be holding out hope for a soft landing. Now, it seems like other officials at the Fed have kind of accepted or seem to be saying, yeah, we are going to have pain. We're going to have to endure pain to get to get inflation down, which people tend to interpret as recession. Maybe just mild, but maybe something deeper if necessary. Is that why you still think that a soft landing is possible when so many people have said, look, you've got to be more restrictive. You've got to get inflation down. You've got to get the funds rate well above inflation, but there's this sense that, no, this is a pretty strong economy and it can hold up.
Yeah, I don't know. There's a big group that wants to talk in terms of a Phillips curve, but the Phillips curve has been flat for the last 20 years, so I'm not sure where the disinflationary pressure is going to come from that channel. You'd have to have the estimates of the Phillips curve are that, even a percentage point on the unemployment rate has barely any impact at all on the inflation rate. So it's a little puzzling exactly where the story is coming from. Do they think, I would challenge them to say, well, do they think it's a nonlinear Phillips curve where the effects get much more serious as unemployment rate goes up? And that's maybe something you could say, but that's not really in the data. So I don't think that's where the disinflation is going to come from. I think it's going to come from the product side of this process, where firms worry about loss of market share, and for that reason they do not want to increase prices as rapidly as their competitors, and this leads to a 2% rate of inflation instead of an 8% rate of inflation.
Okay, but what about inflation expectations? What about the fact that inflation is so far above wages right now?
Because inflation expectations are looking good right now, at least based on TIPS markets. They've come down below 3% for the 5-year and the 5-year forward. Those are good numbers, considering that the headline inflation number is at 8%. So I think we do have the right expectation in markets, and we do have the right policy in place. We're going to the right level of the policy rate, and I think we can get this dynamic to work. I don't really think it's going to work through labor markets the way other people think. And I would say one other thing about this. The unemployment rate's at 3.5%, so most people would have the natural rate of unemployment somewhere in the 4% range, let's say 4.5%. So if unemployment just reverts to mean and goes to 4.5%, that would just be mean reversion in the labor market. You wouldn't expect the labor market to be at stellar levels, which is where it is compared to the post-war experience forever. So you'd expect it to revert. So that would be somewhat more unemployment. But that would not be, would not help, according to the flat Phillips curve, it would not help us that much on the inflation dimension.
Inflation expectations, University of Michigan Consumer Survey, which is a very closely watched, as you know. Right now, this is very interesting, 25% of the expectations in the U of M survey see inflation at 4.8% or more in the next 5 years, but that's the top quartile. The bottom quartile sees it below 0.7% for the next 5 years. It's the largest gap between the top and the bottom of those quartile boundaries since May of 1991. What does that tell us? There's a big, how do we gauge, or how can we be confident on inflation expectations? And the market's break-evens change all the time.
And they can't be wrong.
Right?
Yeah.
So.
Yeah, I think this is fascinating. I think there is some uncertainty about what's going to happen, and we're being, as a central bank, we're being challenged on the inflation front, and we're trying to get a really good policy in place to get inflation under control. But, if you're out there as a household, different households might have different views about whether we're going to be successful or not. And that's why you see this big, this big divergence in the variance of inflation expectations. And
another thing about inflation right now, there's a massive gap between the CPI and the PCE. In fact, let me look at the data here. It's last time it was this high or higher was 79.82, and that was in the Volcker rate era. So you can target the PCE. That's your main measure. Can you ignore this big gap? And CPI is so high, and again, so much above the funds rate. Is that a message you have to respect, that you have to deal with?
Yeah, I think, you know, the inflation target is in terms of headline PCE inflation, so that's our main measure. And we did do a review of this, but not recently, only in the 1990s. The idea was that the PCE measure is a more comprehensive measure of all the prices in the price basket. And so we like to look at that, but certainly the CPI also informative and might match up with some households' actual expenditures a little bit better. So I think what happens is that when inflation goes to a higher level, these differences in measurement start to get magnified,
okay.
And so you see some bigger differences between the different measures.
It's Homer Jones Memorial Lecture. He was one of the, at the St. Louis Fed, he is considered the person who brought research to another level that it hadn't been done before at the banks, real leader, and that's been passed on. So if Homer Jones were here and he was talking to you and your team about this place you're in and how inflation got way out of control for many reasons, and now you have to bring it down, what would he be telling you? How would he be assessing your performance, and what would he be telling you to do now?
He'd probably be telling us we're doing a bad job. He is very data-oriented, and was the things that he did were the precursor of what we now call Federal Reserve Economic Data, or FRED. And I know a lot of the listeners and viewers use FRED, and we try to provide a great public service there. So, he would be analyzing the data just like we were here, and talking about the different components of inflation and how far it is above the inflation target and so on. I think, there are a lot of differences from the earlier era. I think that at the time it wasn't as widely accepted that central banks were responsible for inflation, but he emphasized that it is the responsibility of central banks. And I think the 1990s, he didn't live to the 1990s, but the 1990s are really the decade that vindicated that view, as you had central banks all around the world going to inflation targeting and getting inflation toward target.
Speaking of the 90s, that makes me think of the 80s. It makes me think of Paul Volcker. If Paul Volcker were here, what would he be telling you?
I think the Volcker era really brought about the idea that you need to be credible in your policy. And when Volcker started, the central bank didn't have any credibility at all, and so he had to earn it all from 1979 into the 1980s. But because he did that, I think we're starting off with a lot more credibility. We start off with an inflation target. He didn't have that. We start off with widespread acknowledgement that it's up to the central bank to run the right policy to get inflation under control. We start off with better understanding in the private sector that if you do get inflation under control, which he did, you, instead of having the volatile 70s era, you had this long expansion in the 1980s, then a recession, then another long expansion in the 1990s. So you set off this high growth, low inflation environment, which is very much what we'd like to do now.